Hello, everyone, and thank you very much for joining us for this week's NASDAQ Dorsey Wright Market Update for this Monday, August 24th. My name is Ian Saunders, and joining us here today is Steve Raymond. And we're coming in here to a Monday seeing green on the screen across the board for most major domestic equity indices, with some new all-time highs being printed on some of these indices. So going to take a dive into that today. So from a discussion standpoint, we're going to be first touching on a weekly performance update, an update to that as we typically do. Taking a look at some of the leaders and then laggard areas across the market over the past week through the end of trading there on Friday. I'm also going to be taking a look at the new chart high that was printed with movement this morning for the S&P 500 index, and then how that has affected some of the continued improvement we've seen for major domestic equity areas, how that's affected some continued improvement in the dynamic asset level investing, or DALI tool, for the domestic equities in relation to fixed income. Taking a look at that and some individual sectors that have been leading the way for that asset class over the past several weeks. And then we will finish by wrapping up with what we're seeing going on underneath the hood of the asset class group scores page from a macro perspective, and then taking a look at some other groups that are showing some more near-term strength that could be potentially areas to keep an eye on for further improvement as we look towards the close of the year. So coming in through the end of trading there on Friday, taking a look here at the performance breakdown for many of the major equity sector representatives, as well as some various other spaces going on in the marketplace. Saw that last week was definitely a positive week for those more risk-on, growth-oriented areas. Technology sector fund, ticker XLK, leading the way here from a 7-day performance, trailing performance aspect, with the return north of 3.5% over the 7-day trailing time frame, bringing its year-to-date outperformance up even higher to 28.66%. So definitely a continuation of some movement that we've seen going on in the domestic equity place over the past several weeks, as that technology area has really been one of the major leaders and bellwether areas that has led the market higher with this recent rally that we've seen. Momentum also did pretty well last week with a return north of 2%. Looking there at the Momentum ETF representative, ticker PDP, our partner that we partner with Invesco on. But some other areas, consumer discretionary, communication services, also each posting weekly gains north of 1%. So strong continued outperformance from those areas, and have been places that we've continued to see grow with this rally that we've seen. Looking at the laggard perspective, energy, not a great week for energy and financials. Saw energy being the worst performing sector representative in this breakdown that we are examining this afternoon, looking at a loss of negative 5.66% through the end of trading there on Friday on that 7-day performance aspect. But continuing to see some of those areas, at least with movement at the time of this webinar this afternoon. Some of the financials and energy are actually looking like they're bouncing back a little bit here today. And so we're continuing to see that kind of broad participation on the domestic equity side of things that has led to these new all-time highs that we're getting for the S&P 500. So in taking a look at the S&P 500 on a 20-point chart, as we have been monitoring, we got that chart that went back and matched its all-time high for February there last week, moved to a new closing high last week as well. And then coming in here this morning, looking at gains across the board, ultimately bringing us to an intraday high of 34.20, which is going to print 2 additional X's on this 20-point chart and takes us past that 33.80 resistance point, which was that all-time chart high that we reached back in February. So now moving past that, moving to the new all-time highs on this 20-point chart and on the default chart that you'll see for the S&P there as well. So continuing to see that follow through that we've been looking at 3 consecutive buy signals now for the index, most recently given there towards the end of July, and continuing higher here in the month of August. Initial support is going to be had on this chart there at that 3220 to 3200 level. Previous resistance point that we got to there in June and July that we had surpassed, but we look towards that is that kind of first resistance area, with further support coming into play there from July at the 3120 to 3140 point. But Steve, definitely a good indication to see that resistance point at 3380 finally broken through here with trading this morning.
Yeah, we were wondering about that for a while as the S&P index on the end of day level, which, most investors are watching, pierce through those high points last week. The futures, however, did not join them last week. It wasn't until last night, Sunday night, that the futures broke into its new high level. And then you had some pretty good follow through later in the night, big surge around 1 and 2 and 3 in the morning and some follow through here. So you have, a lot to say the markets made it back to and exceeded the what we refer to as the E-Trade high back in February, where the sell-off, really could be pointed at as that peak, and get you back, to the point where we're all the way back, and we have a lot of great relative strength. There's a lot of good offensive tone that has been going along the way, and those are some things to keep in mind that the market, as some suspect, maybe there'll be pullbacks, and as I often say, maybe there won't be. One of the risks of markets breaking into new highs, it can keep going higher. I think that's one of those risks we have to account for in portfolio management to make sure we're properly and adequately exposed according to the offensive principle. Keep in mind, there's as Ian mentioned, there's several support points. I would think on the S&P, the end of day index, that 3,100 level seems like a good spot for an investor alert that maybe there's some intermediate issues if we broke that support level, which is a fair way down. And then from a futures point of view or from a sticks chart point of view, the 3320 area breaching below that could give you an idea that they're trying to settle out and consolidate some prices on the downside. However, we don't know if any of those two will be violated on the downside, but those are good portfolio actions to take a note of as they present you some action points to take advantage of on either side. Barring that, the market's had a pretty good run. Really, it's August all the way to July to get the market up into the strike range, but it's really the function of August really to push all these indices right through on the core S&P. And from here, if there are any modest pullbacks, they may be very modest and very quick-lived. As we continue to head through the end of August, which is seasonally a weaker spot in the market cycle, that means we go into September, which also has some historic weakness built into September. But we don't know if those adages are going to hold up there. So what we're looking at is to take these offensive moves and to continue to play the game plan we've been playing, which is maintain offense, buy on pullbacks if they present themselves, but also you may be forced, to buy without the pullback. And I think that's an important point to settle on as the you could say the day that the market in all its various formations, futures, index price, EOD, which means end of the day, we're really getting here to the point where we're breaking into new ground, and offense still has the the football here. Back to you, Ian.
Yeah, absolutely, and thank you there, Steve. And one of the points you mentioned there, continue to see improvement and follow through from the absolute strength perspective, but then you also touched on that we're continuing to see upside from a relative strength perspective. And one of the ways that we've been tracking the relative strength improvement for the broader domestic equity space is through the dynamic asset level investing, or DALI tool that we have on the platform, which is going to be a ranking of the 6 broad asset classes that we have from a long-term relative strength perspective. So imagining that you're on that jumbo jet flying over top of the market, and this is where you would kind of see strength going on down on the ground level. And looking at that, we still see that fixed income is still in the #1 ranked position there at the top of the broad DALI asset class ranking with 229 buy signals. And domestic equities has now risen to trail fixed income by just 3 signals, improving there to 226 buy signals after overtaking cash back a few weeks ago. And so we continue to see over the past few weeks here a further follow through from a buy signal perspective, with domestic equities picking up buy signals and fixed income continuing to drop buy signals, bringing those 2 asset classes much closer together. And so in order for domestic equities to move to #1, we would need 4 buy signals for that to occur, for that to then overtake fixed income in the number one space. And one thing to keep in mind is that could come either from domestic equities picking up 4 buy signals or from a combination of fixed income losing buy signals and domestic equities gaining buy signals. As we see in this particular case here, looking at the most recent movement through the end of trading there on Friday, we saw cash lose 2 buy signals. Domestic equity picked up those 2 more to bring it to 226, to bring it much closer there to the fixed income asset class. But in looking at the differential between fixed income and domestic equities, from a buy signal perspective, they've really been heading towards a convergence point now since the domestic equity market began to rally there towards the end of March and in April of this year. We saw domestic equities fall from the number 1 ranked asset class with a buy signal count of north of 330 buy signals, as you can see here on this graph looking strictly at the buy signal differential between fixed income and domestic equities on a year-to-date basis. Domestic equities was all the way up above 330, fell off significantly there to a buy signal low of 159 buy signals by the end of March there, and then began to pick up a little bit. Fixed income, on the other hand, saw it move up in the asset class rankings, ultimately reaching a buy signal count of 271 buy signals by mid-March. So domestic equities fell to 159 and has risen from that point to its current count at 226. Fixed income, on the other hand, rose to 271 and has now declined to its current buy signal tally of 229 buy signals. So as I mentioned, we do want to wait to see domestic equities fully move into that number 1 position, and we usually identify transitioning to number 1 by or transitioning above any asset class rather, by a 5 signal differential. So in order to really cement that change, in order to look towards a point to go ahead and implement those changes in any strategies that you may be following, we do want to see a 5 signal differential there between domestic equities and fixed income, if domestic equities did overtake fixed income, in order to really cement that change in a number 1. But definitely, at least certainly by looking at this graph, seeing that convergence point is coming. Now, whether or not it actually is taking over is another point that we can continue to keep an eye out for. And for those of you that do have a Nasdaq Dorsey Research subscription, that is something that you can set an alert for on the Dolly page, to go in and set an alert for asset class changes, to be sure to be notified of any subsequent movement. But obviously something you can come in and take a look at each day there as well. And in looking at areas that have really been those leaders within the domestic equity space, continuing to push the domestic equity space higher from the buy signal perspective, seeing that those growth-oriented areas, we've seen technology, communication services, consumer cyclicals now being in the top 3 positions of the Dolly tool. We saw communication services move above energy to be the 3rd ranked sector in the domestic equity breakdown there in Dolly. And from a background perspective, this tool is going to function in its sector breakdown functions in a similar fashion there to the broad asset class breakdown, just looking at a separate relative strength comparison. So those areas to the left in the most green will be those sectors with highest relative strength. Those areas to the right, consumer non-cyclical real estate, then the darkest red will be those areas with the least relative strength. And we've seen communication services advance above energy there by breaking that 5 signal differential to be solidly cemented there in the 3rd position. It's important to note that energy still maintains a position in the top half of the sector breakdown. So still seeing some relative strength there, just not as much as it was previously, with communication services and really technology, those areas continuing to push the broader domestic equity space higher. But will certainly be another area to keep an eye out for. And this is another place that you can come in and set an alert there on the platform if you want to be notified of any further movement from here. But we've also seen some interesting moves in on another side of the coin in looking at a different kind of ranking that we have on the platform, looking at the asset class group scores view, specifically with looking at coming in and taking a look at that macro view there, Steve.
Yes. In fact, from a macro point of view, that the S&P 500 core maintains its leadership as it's done primarily for quite some time, and the percentile rank of that strength is in the 94th percentile against all asset classes around the world. So you do have some equity core dominance, you could say super dominance there. And other equity groups are joining along, including a variety of large caps, cap-weighted type asset classes. Keep in mind that this force of large cap core, really holding up primarily the markets through some of the bad times as well as some of these times, which some of these times are quite good. The Dolly apparatus, could generate, 5 signals in favor of equity. As Ian just pointed out, the rules for that quite easily. It could be one day's good action. And we'll have to take a look at this reading overnight for Dolly, and then of course tomorrow. But this is not something that we'll be continue to come back on for weeks and say, hey, let's take a look at a couple weeks of readings. This could be one day, or theoretically could easily be a one-day move. According to the asset class group scores, the core still maintains a fairly smooth over dominance. The money market percentile rank has been dropping pretty steadily through August. Again, it's considered a weaker month of the seasonal cycle, but in our case, we've seen the market provide a lot of strength. In doing so, the money market rank has dropped down near the 6th or 7th percentile. That means cash is as strong, stronger than 7% of the asset classes around the world, which means that 93% of the asset classes around the world are functioning very well, providing new asset allocation opportunities. That would be both from the fixed income and equity camp, both U.S., non-U.S. camps. Remember that fixed income is still quite strong. On average, any type of fixed income fund, whether it be a mutual fund or ETF, scores at a net score of over 4, which is extraordinary from an historic point of view. And we're still there. In the fate of the ultimate strength of fixed income still waits to be seen, but it is a player, and certainly an important player in an asset allocation model. So, I think that there are other asset classes we could speak of, and maybe we'll do that in a moment or so. But I think that the key is the market's broken into a new high price mark. You still have a lot of power in the large cap core and the S&P core equity camps, certainly the NASDAQ, and there are other big camps there that have been carrying the market up through here. But I would like to point out that it's still that it's moved into a broad market scenario through the July and August timeframe. But the key thing to leave today's call is that we have excellent core strength in the market, and we have a market breakout. So that tends to support and add another reason to say we're on offense, and there's a new type of offense and breaking into new ground. And so again, you're looking through your inventory, you're looking through your allocation, taking advantage of all these various asset classes that can certainly help your allocation. So Ian, I think it's still kind of a stable core scenario, and the money market's been precipitously dropping. Typically, if you look historically, money market sub 10 readings do happen. Often they can get down into that low sub 10 reading for months and months. You just don't know. That's why you have to look, set alerts. As you can also set alerts on the asset class group scores to be alerted about your favorite groups. But the money market still abating south tends to also be an offensive tone. That it's more of a risk-on market, and certainly a risk-on with a lot of other groups. Back to you, Ian.
Absolutely, there, Steve. And I mean it's something. I mean, talking about continuation or further follow-through, right? I mean that U.S. equity core percent rank, getting back towards the higher levels that we saw there in early June before it did back off a little bit, but continuing to show real elevated territory. And money market continues to drop, like you said there, and looking not that many groups that are going to be beating money market. And a lot of that as well as we've seen when we look at something from the directional standpoint, we're still seeing a very kind of broad representation of a lot of different areas across the different marketplaces that are continuing to push up in the higher scores there, Steve.
Yeah, and as we move to the directional sheet, we've actually spent some time, many weeks, many calls, several months, looking at the directional view because it's the appropriate view in this context to see how things have improved off what you would call a severe market sell-off in the February through March timeframe. And what we have here is again, the substantiation of how broad the market is now, where you have many, many asset classes that are scoring well, some scoring better than others, but many who have a score direction that's super positive, meaning that they've gained a lot of score points in the near term. There are more asset classes that score above 150 or score above the score 2 than are practically able to iterate. The market's so broad. So this is great news for those of you that are using particular asset allocation strategies, maybe some asset allocation structures or asset allocation pies from various firms, where there's a lot of asset classes that the guided model would want to buy, and certainly each of those types of sleeves and those particular strategies do have actually a lot of groups that are improving pretty rapidly. So that's actually I think a good time for any of us working with strategic allocations as well as focus allocations, which Dorsey Wright's typically more well known for. Now, as you take a look at the score directions, we do have some oscillations in there, but basically you have some materials types sectors and some non-U.S. type exposures like India and emerging markets. Emerging markets diversified, a very, very, very important group, and you have microcaps. You have some things telling you that the market's broadening out from a U.S. to non-U.S. It's also broadening out from large to smaller cap, and I think that's very important as you go through your inventories and continue to. In other words, it's a step-by-step process where some months ago you're adding into some large caps, and then some weeks ago you're adding in the small caps. So that it's that process of getting up with the allocation as the groups tend to migrate. I think in an honorable mention this week, I'd also like to mention convertible bonds, which is ranking very well in score direction. It also happens to be a score very close to the 5 level. So the score 499 posted to probably cross that 5 level, I would assume, sooner than later. And this is a phenomenon. The corporate bonds scoring this high, you would have to go back to 2003 to find this type of fund score for the very, the few and the important convertible bond exposures that are out there. And then prior to that, historically, from historic research, the convertible bonds had a massive move in the first set of the 1990s. So rather than interpret what that's going to mean, you could say that the inflection of corporate of the convertible bonds is an important function, and sometimes it precedes other larger market economic moves. But certainly, convertible bonds could be a key player in your inventory to help out your bond exposure, as well as be a signal or a sign, that the market is getting more risk on, as well as more of a macro thematic yearly sign that, that maybe there's some better things coming down the road. We'll have to play that, manage that, as we go. And so the convertible bonds are, really I think a big story. The small caps, continue to improve again on this canary in the coal mine situations. The micro caps are near the top of the score direction sheet. As I continue to mention on the call, the micro caps may or may not be something that your firm will permit you to use or that you prefer to use. But I think it's a signal that some of those great small cap funds are also doing well. So small growth, small core, and in some cases small value can be added to the allocation to give it some breadth. And I think that's an important function to do. And then back to what I would call, I think a main, monthly story, which would be the non-U.S. component to the asset allocation, picking up, holding some good scores, the emerging markets being above the score of 4. Very important to see this type of, traction, come outside the U.S. to add that, in some sense, diversity, if we could use that word, back into your allocation as you pick up some opportunities in the emerging markets where, in some sense, they have not broken into new highs, but in a very good sense, they have excellent relative strength and score direction. So it gives you, again, a chance to continue to remind the clients there's a lot going on, both in the non-U.S. as well as the U.S. spaces. Get them involved, continue to say, we're minding the shop. There are things to do, and then kind of outline your game plan of how you're participating in these assets during this season where offense is taking control, and in many cases, in some areas of the market, has been in control. So I think it gives you a lot to think about as we head for the September, and then October, and then November, and then December. So the rest of 2020 is about getting on board with at this point a broader allocation. And keep in mind that broader allocations that have a lot of asset class components within them are, in essence, theoretically, less risky, lower our risk on aggregate than it would be if you had to pick a single sector, or you picked a single asset class, or you pick a single fund. The whole aggregate is where that diversity comes into play as being extremely beneficial. And this is a textbook time when the asset classes are in play, allow you to take exposure to a lot of different asset classes. Well, then certainly do so. That helps your entire portfolio out and enables the portfolio to weather different storms that we may know or we may not know about, as we go through the rest of 2020. So it's an excellent time for you to continue your portfolio management and get up to speed, with this broader, thematic that's coming through the market. So, Ian, a lot to say, about primary asset classes. Some of them are very strong in score. Others are very strong in score direction. But it does give, the advisor a chance to practice true breadth selection and make the allocation, more diverse and in some sense, lower that relative risk. Back to you, Ian.
Well, thank you, Steve. And I mean, you mentioned there, continuing to see broadening out for many different areas across the markets, and not solely oriented just towards the domestic equity side of things, like you said, but a lot of these international areas continuing to show advances as well. I mean, China, as we can see here on this page, score 4.56. Have really been one of the leaders in the international side of things from a strength perspective, maintaining a score above 4 for quite a while now. And now some other areas are moving north as well. I mean, we saw global international growth move above 4.0 there earlier. Now emerging markets diversified up there. You have Europe, which is getting pretty close to hovering right around that 3-score line. So really that kind of broadening out is something that a variety of reasons for it. And one of those also being the continued decline that we see from the U.S. dollar perspective, with the dollar weakening against this kind of basket of currencies that we stack it up against. And that has a variety of potential tailwind effects that we've talked about in the research here over the past couple of weeks. And one of those as well has been some of the improvement from the commodity side of the coin as well there, Steve. Is that right?
Yeah. And in fact, you could make this statement, any week or any month over the past few years, that each time the market is sold off as a global event, if you will, the commodity scores have made higher low score levels, meaning higher bottoms on the score. What you're looking at here on this graph is the actual score of the commodity universe, not the price, but the score, which is its relative strength footprint in and of itself, to itself. Where's that score path? And just noticing that the scores have been, in some sense, going to higher bottoms over the years has always been a long-term thematic that one could talk about. But I think that we bring it up here and maybe make it an honorable mention over the week or two is that the commodities are about to challenge the 3-score line. I think that appears imminent. And then we're left with the next thing to say, which is it's tried to do that a couple times over the last 8 years. As you can see from the score graph, it's been unable to hold a position above 3, really for more than a few days out of those 8 years. But bringing up today to say, well, maybe this time's different, and that's what you want to get ready for is, news stories or big thematics. These are what you call the close calls. Let's get in there early and let's say, hey, the commodity space is picking up some relative strength in such a way, and probably will breach the 3-score line, and possibly could hold the 3-score line and above for some time. And I think that's an important event to call out before it happens, because that could lead to a major reinflation of the commodity group on the score level, getting us back to the idea that maybe this is a very good citizen of an asset class. And if that's true, we want to be on that story early. And if that's true, we definitely want to be on the story to help and aid the asset allocation. Remember some years back, a decade ago or so, the commodities were extremely helpful in the asset allocation endeavor, and incredible performances out of the commodity space. As you recall, for those of you that that remember those days, or for those of you that have been in the business longer than 10 years. So this is a kind of an important point in asset allocation where commodities are considered a non-correlating asset, as is fixed income, and in some sense non-correlating to equity. So it's one of those bigger non-correlating pieces that's very important that I think for the asset allocation for your client, but also could be a big returner. Now, as you know, when commodities are down and out and out of favor to the point where they score in the 1 area or they score in the 2 area, it's real tough to drag them along with the application because they cause a little bit of a portfolio drag, and your return profile sinks because you're simply carrying the commodity package or an alternate package simply because that was part of someone's strategic design. So what I'm coming back to is from the other side is that, I think commodities become an important player when they're productive. And then they really, help with those metrics, the smoothing out of the return profile, not to mention possibly excellent returns. So I think that what we're saying on this call is this is a time to say, hey, there are some things going out there. We're in the early phase of looking at that group become a solid citizen. Gives you time to go and look at your commodity inventory, which may be mutual funds, it may be ETFs, it may be both. And then you look at that mix and try to get your inventory ideas, together. Let's see how this goes. But I think it's an important honorable mention. A down and out area, could be a very important area. And the only way it can become an important area is to get those scores printing above 3 for some sustained time, and then make the voyage north from there. So, Ian, I think it's an interesting, if you will, contrarian development. Some put commodities in the value space. I might be one of them. And again, it's just another way to say, hey, I'm looking at a lot of things for an allocation, not just a single stock, not just did Apple split or not. That's not the only story on the street. There's a lot of stories on the street, and I think that's what you put together and gives you an arsenal of things to go ahead and say, hey, this is what I need to call my client today. As we're ending August and wrapping up the month, and we're starting September. If there are schools, people are going back to school. There's a lot. There's some new things to say. Hey, we're entering into the brave new world, and let me call my client today, and let's keep up with this game plan. So, Ian, I think it's pretty interesting. As we talk about breadth, I wanted to mention, some other lower relative strength breadth that could actually end up being an interesting story. So, and that's why we brought it up today, and we hope hope that's convenient for everyone to take some time and look at those inventories. Ian, back to you.
Perfect. Absolutely there, Steve. I mean, you said it perfectly there. I mean, we're looking now at the time of the year that's typically not all that much going on. A lot of people on vacation and kind of ramping up for the busier fall year earlier. But nonetheless, I mean, still no shortage of stuff that we're seeing going on, that is going on in the market from a price standpoint, with markets making those all-time highs, continue to look forward domestic equities to move above the fixed income asset class in that dolly tool, and then taking a look at some of these other areas that might not necessarily be in favor quite yet, but certainly have given indications of improvement, that they might very well be there in the near future. So for those that are looking to follow any of the information or looking to get access to the research platform to track any of these indicators or set any of these alerts that we've touched on here this afternoon, definitely you can visit us at www.dorseyright.com/trial. to get signed up there for a free trial of the research platform. Those of you who are already subscribers, logging in there, www.dorseyright.com/login, and be sure to set any of these alerts that we were touching on here this afternoon. If you have any questions on anything that we covered here today, or really anything at all, always more than welcome to reach out to the analyst team here by phone at 320-8511. Anything you'd rather type out rather than necessarily talk about, more than welcome to shoot us an email as well at dwa@dorseyright.com. So with that, Steve, thank you very much for joining us here this week, and it was great speaking with you all. I want to thank everyone very much for joining us, and we look forward to having you back next week.